Tesla's been valued recently at more than the total value of the US and European automotive market combined.
Hey, this is Warren Redlich. Just a quick video breaking down how another Wall Street analyst gets Tesla wrong. This is an analyst named Craig Irwin. From Roth Capital. You can see him highlighted here. This is from Tip Ranks. What stands out about Irwin compared to a lot of other analysts is he actually has a high rating. He has more than 4 stars on his rating, so he gets a lot right. Why is he so wrong about Tesla, picking Tesla with a price target of $150 a share when Tesla is now trading well over $700 a share? To be fair, I sent an email to Craig Irwin asking him to do an interview on my channel. He did not reply. You can see this is a guy that CNBC puts on. They ask him his opinion. They let him talk. They don't really ask him critical questions like they should. So I want to break this down and show what he's getting wrong, why he misunderstands Tesla. I don't know if he misunderstands or he's lying, but I want to break this down and show what he's got wrong. It's important because he's a relatively high-rated analyst as opposed to some of the other guys who have terrible ratings. It's easy to dismiss them. It's harder to dismiss this guy. Quick thank you to the Vasa Law Firm in Sweden and all my Patreon supporters for helping this channel grow. There's a link to Patreon in the description below. Patreon supporters get early access to some videos like this one. They get access to my spreadsheets and they get better access to me in terms of messaging because I respond to my messages on Patreon more frequently.
At this point, I think valuation is not really the main game. I think people are playing technicals and trading momentum, and the external factors from the yield curve, the anticipated changes in the yield curve are really more what's driving the stock than valuation.
This is the start of an inconsistency in Irwin's explanation. He says the reason the stock is so high has nothing to do with valuation. It's people are doing technicals. That's this idea that people are looking at how the market moves. They're judging momentum. They have this technical analysis about how a stock curve looks, and they make judgments. And it's a very short-term way of thinking, which he's going to conflict with later when he talks about why long-term Tesla bulls have a different reason for why they value the stock. So you got to make up your mind. What's your explanation here? So I'm just going to say this. Technicals have nothing to do with it. Technicals drive short-term trading. They drive short-term stock price movements. They will not take a stock from 150 up to 700. That's not how it works. It's up at 700 because there is a long-term valuation reason, and Irwin doesn't get it.
Is the street rightly folding in things like data from autonomous driving, batteries, electric grid?
The bulls all believe that there's a lot of value in the software in the Tesla cars. They're dreaming of, $100,000 in value per car, robo-taxis, fully autonomous driving.
That's the inconsistency I was talking about. First, he says it's technicals and people aren't valuing the company. Then he says the bulls are thinking about these things like robo-taxi and full self-driving, full autonomous vehicles. Of course, now it is about long-term thinking, so it's not about technicals. So this is where he's lying to himself or he's lying to us. Irwin! Another important detail is that he's wrong. I'm a Tesla bull. I'm a long-term Tesla bull. And I do think robo-taxi, full self-driving is a big component of how Tesla could go to much higher valuation. But that's not where I get $700 a share from. I get to a much higher valuation than $700 a share by looking at production, by Tesla producing larger and larger quantities of vehicles, larger quantities of batteries leading to larger numbers of products. And this doesn't seem to cross Irwin's mind at all. He doesn't seem aware of it. The guy from CNBC actually asked him, he actually mentioned batteries, and Irwin didn't mention batteries. If you look at battery production and you think Tesla is going to get to 250 gigawatt hours of batteries produced and used from suppliers in 2022, which is a fair guess, and they're going to get $600 in revenue per kilowatt hour, which is what they get now, you're going to get to $150 billion in revenue in 2022. That is a 5x increase from 2020. That is very, very rapid growth. It's likely to include a lot of profit because they've already started to make a little bit of profit. And as they grow, you're going to see a lot more profit because scale helps with that. And he's not grasping that at all. It's, again, is he unaware of it? Is he unaware of the battery plans? This is a pretty big problem for a lot of Wall Streeters. Whenever I see somebody criticizing Tesla, I just ask them, fine, how many batteries are they going to make in 2022? How many batteries are they going to make in 2030? And it's not on their radar. I don't know if they don't think about it. I don't know if they didn't watch Battery Day. They didn't understand Battery Day. He doesn't seem to get it.
And we understand that Elon actually talks, when he thinks he's far from Wall Street, about taking on the railroads with his autonomous electric trucks somewhere out in the future. So there's a lot of sort of lofty dreams around Tesla.
That would come under the category of making shit up. I'm not saying Elon has never mentioned the idea of Tesla Semi taking some share from trains. I think that's going to happen down the road. But there are 200,000 Class 8 work trucks, semis, sold in North America a year, another million in China, and another 500,000 in India, and then you've got Europe. There's plenty of trucking market to deal with before we worry about rail. I don't count rail in my valuation in any significant way. I've never heard Elon talk about it. I'm sure he's mentioned it somewhere, but I've never heard him talk about it. This is not something that Elon worries about what Wall Street thinks and all of a sudden drops off with, aha, we're going to conquer the rail industry. Maybe it happened, but certainly hasn't happened recently. I follow Elon closely. I don't see that in any way as an explanation for Tesla's share price being at $700 a share and why it's worth much more than $150 a share.
They hang their hat on what they choose to hang their hat on. I'm not a bull. I'm a skeptical guy, so I don't see much evidence for that playing out that way. But I understand why the stock is moving. People are buying it off a technical level, and they have pretty aggressive long-term expectations.
This leads to another problem with the way Irwin talks. Irwin! He refers to Tesla bulls having pretty long-term expectations. Right, I do have long-term expectations. My expectations for Tesla are very high. And when I look out to 2025 and 2030, and honestly, 2026 right now, my ballpark estimate is somewhere between $20,000 and $25,000 a share just in 2026. But going out to 2030, $40,000 a share, $50,000, $60,000 a share, all within reach if all goes well. So that's my, yes, crazy valuation. But if you back my valuation down from, say, $20,000 a share in 2026, coming back to 2021, the number's a lot higher than $700 a share. Stock is worth $2,500 a share, $5,000 a share. It's massively undervalued, not overvalued. And here's the problem with him saying that. Fine, you think my long-term expectations, my long-term valuation for Tesla is wrong. What's your prediction for where Tesla's going to be in 5 years and 10 years? How much do you think the company's going to be producing in terms of revenue? How many batteries are they going to produce in 2026 or 2030? How many vehicles? Do you think they'll ever reach autonomy and robotaxis? If they do, what are those things worth? And how do you get to a valuation in the future? And how do you back that down to today? It's easy to take pot shots at my estimate of the valuation for 2026 and 2030, or some other Tesla bulls estimates for 2026 or 2030. If you don't have your own, if you don't come up with your own estimate of where you think they're heading, then it's easy to just take pot shots at somebody else. So come on, Irwin. Irwin!
Do you think there's perspective to be had on exactly why it's gone on the run, what it means, and kind of what that says about what Elon Musk and the company have to continue to do not to get trapped in this trade?
Yeah, well, it's a momentum story, right? And the first quarter has traditionally been for Tesla a very difficult one. It's where that lofty idea runs into the cold, hard reality of making cars. And for a lot of reasons, they struggle in the first quarter. And Elon hasn't really shown a consistent ability to make profit or see sales growth the way Wall Street wants to see in that first quarter.
This doesn't really make sense because the interview took place on April 5th or 6th. You can see here, was reported on CNBC on April 6th. They reported deliveries on April 2nd. They had record deliveries for the first quarter. They had growth, not only growth year on year, but growth compared to the fourth quarter. So there's this guy Higgins from the Wall Street Journal who brought up this quarterly issue. And the reality is that all car companies struggle in the first quarter because the first quarter is considered a seasonally weak quarter. People focus their buying in the last 3 quarters and especially the fourth quarter, and there's not a lot of demand left in the first quarter of the year from January through March. People are buying up in the fall is particularly big, and up through Christmas is particularly big. You get to January, February, and March, and a lot of the demand has already flown in the last part of last year. You get into the new year, there's a lag usually. Despite that normal holdup on demand where everybody expects you're going to have trouble meeting expectations, They outperformed. They sold more cars than Wall Street thought they were going to sell. They sold more cars in the first quarter, which is slow, than they sold in the fourth quarter, which is usually strong. This is an amazing quarter, and they're downplaying it. I don't know where they're getting this from. And when you look at this performance, about this 180,000 produced, 184,000 delivered in the first quarter, and you extend that out for the rest of the year, and you recognize, and again, something they don't seem to talk about, they don't seem to see, Tesla has 2 new factories about to come online. They got the Shanghai factory, which is still increasing output. They're making some progress in Fremont, probably get a little bit of increase out of Fremont, but they're adding 2 new factories that are probably going to start putting out cars in the third and fourth quarter, maybe sooner. So you're going to have all this extra production. So you're going to see 2021 potentially have 1 million cars, which would be double last year. These are amazing numbers, and they're just ignoring it.
And so this is the big test here, right? The beginning of the quarter, we saw some numbers that maybe suggested the growth was kind of coming off. And now we're seeing some numbers out of China that suggest, wow, it's really still hot there. And so it's really confusing on top of all these other confusing signals for what's going on with Tesla right now.
Yeah, it is really confusing because you got your head up your ass. Pull your head out of your ass and take a look at what's going on. Take a genuine look at the company. Are you aware that Berlin is being built, that there's a factory in Berlin being built? Are you aware about Austin? Have you thought further down the road if they actually manage to deliver FSD? Say that you think there's only a 10% chance of delivering FSD and robo-taxis. Okay, figure out what you would value it at, and then add only 10% of that additional value to your current valuation. The problem is robo-taxi is so valuable that 10% of robo-taxi is still a huge jump in valuation. But if you don't do the analysis, you can't get there, and you can't get there if you got your head up your ass. Let's look at another interview with Craig Irwin that took place before the first quarter deliveries. Keep in mind, he didn't change his numbers after the first quarter deliveries beat expectations.
Let's bring in Craig Irwin from Roth Capital. He's got a neutral rating, a $150 price target on the stock.
My $150 price target is where I would be an aggressive buyer of the stock. There's no sane reason for the stock to have had the valuation it had, valued at more than the total value of both the North American and European automotive sectors.
What he just said there, valued more than all the other car companies basically in North America and Europe. This is an example. It's the opposite of first principles thinking. You should be thinking, what is this stock worth based on what it's worth? You shouldn't be comparing it to others. There's reasons why the other car companies are not valued very highly and Tesla is valued very highly. The other companies are deep, deep in debt. Volkswagen, for example, owes like $200 billion in long-term debt. $200 billion in long-term debt. They're not growing. You've got a combination of companies that aren't really making a profit, they're not growing, and they've got a huge amount of debt. And as you see Tesla growing, that's going to cut into their market share. And as they're pushed to some extent to make electric vehicles where they're not going to make as much money as they make on gasoline cars, if they make money at all, they're going to make even less profits or they're going to lose even more money. They don't have a viable business model anymore. Tesla has a viable business model. They have a growing model of making profits and getting bigger and increasing revenue. The other car companies are losing revenue, losing growth, losing profits, and they're deep in debt. That's why they don't have high valuations. This is like when Bernie Sanders and Robert Reich complain that Elon Musk and Jeff Bezos have more wealth than 40 million Americans. First of all, they're wrong. They have more wealth than 120 million Americans. I have more wealth than 120 million Americans. You know why? Because 120 million Americans don't have anything. The 120 million Americans are broke. They have negative net worth or zero net worth. When you add it up, you got to get to 121st million Americans before you get to an average of more than nothing. The fact that Tesla is worth more than a bunch of companies that are worth very little doesn't say very much. It's a different category. Tesla is a growth company. They're all companies in trouble.
We need to say that Tesla actually does have some levers that it is pulling this year. The entry into India, the upcoming mini car, these will have very large units, both of them. India will be just as good as China. The mini car will be more probably than the S, X, and 3 all put together. It's a very good concept for the European market, the Indian market, and I think the Asian markets as well.
What's really striking is even when he says something positive, he's at least half wrong. There's no way India is going to be anywhere near comparable to China. India is a much poorer country. China is the largest car market in the world. India is way below fifth. Japan is fourth. The number of people in India who can afford to buy a Tesla is a very small number. Even though it's a big country with 1.3 or 1.4 billion people, there's only 10, 20, 30 million people who could conceivably afford to buy a low-end Tesla. I think he's right about that compact, the smaller, he's calling it a mini. I don't think it's going to be a mini, but the vehicle that Tesla's working on, that's going to sell more volume than Y3, S, and X combined. Yes, it will. Then why aren't you valuing that? If you think it's going to sell that many cars, then you should be valuing that pretty highly. Where is that? How did you work those numbers? I don't know where you're coming from. And, put some numbers on it. How many do you think it's going to be? Because I'm seeing 6 million vehicles a year for 3, Y, S, and X and Cybertruck. And throw in Semi, it's a low volume vehicle, but throw in Semi and Roadster, they're low volume. But I'm seeing in the ballpark of 6 million vehicles a year before you get to the smaller vehicle that Tesla's going to start producing in 2023. 3Y, SX, 3 and Y in particular are going to scale to, with everything else, you're going to get Tesla to 6 million vehicles. Before they get to that 6 million, they're going to start producing the compact. The compact's going to add more. And that compact is going to add another 12 million vehicles a year. This is my modeling. This is where I get to in 2026, where Tesla is selling 18 million vehicles a year. But Irwin, what's your number for 2026? How many vehicles do you think they're going to produce? And what does that mean for revenue and profit? Irwin?
What do you think is actually driving this valuation?
There's a lot of enthusiasm for a variety of things. One of those is software, which I think is a spurious argument. You look at the software content in vehicles today, the nav systems in cars. Who buys those now, right? You use your iPhone, you plug it in, and you have a superior system to what the automotive OEM is offering.
Software is kind of too broad of a term because there's different areas of software that come into play. So Tesla selling software to go in the car when you're not driving is an area where they can generate some revenue. But Tesla itself, Zach Kirkhorn and Elon, they both downplay the revenue potential of software, of that kind of software. But the full self-driving software is a totally different thing, and comparing it to the nav system in an OEM and these old car company nav systems is ridiculous. Self-driving software is different. It drives the car. It doesn't just tell you where to go. It takes the wheel, it controls the pedal and the brakes, and it's amazing. And are you not watching FSD beta videos? I'm not saying it's there yet, but it's getting close. And maybe it's a month away, maybe it's 6 months away, maybe it's 2 years away, but at some point it looks like they're going to get there. And I think it's going to be quick. I think it's going to be 6 months, maybe a year, and we're going to see this going full bore. And that's a huge jump in valuation that should be added unless you ignore it, which that's what he's doing. One last thing I want to cover. Irwin was asked in the article that accompanied the video, apparently there was some conversation that we don't have on video, where he was asked what Tesla would have to do to justify its current stock price. And he said they would really need to deliver on the robotaxis, the fully autonomous vehicles. And then he said Tesla appeared to pull back its efforts in that area, while other companies are coming out with vastly superior technology. What? What is he talking about? Tesla isn't pulling back on self-driving. They're going all in. They're doing FSD beta. They're getting ready to roll out version 9. Does he not know this? We've been talking about that. Anybody who follows Elon, who follows Tesla, knows this is coming if you're paying any attention at all. And who has vastly superior technology? Where's that coming from? That came out of, I haven't heard anybody say, there's people who are saying there's other companies that might be close, or some people think Waymo's ahead because they have some crappy project in Arizona they haven't been able to expand in years, and their CEO just left. The Waymo CEO left. If a junior vice president of some nonsense thing leaves Tesla, there's a headline in CNBC and whatever saying, oh, Tesla's executives are leaving. The CEO of Waymo left. Where's all the press saying, oh, Waymo's in trouble because the CEO left? That's the FUD. That's the FUD. But There's no vastly superior technology. Nobody has anything close to what Tesla has. I don't know where he's getting that from. It's nonsense. If you like this video, check out my video where I went through Gary Black's analysis. Gary Black is another Wall Streeter. Or check out this video with John Engel. Of course, please support the channel on Patreon, link below. Check out the t-shirts, Let's Be Less Wrong, link below. Buy the book, Fair DUI on Amazon, great ratings. And thank you so much for watching.